Good evening and welcome to our monthly market insight with an overview of the fixed income markets by UTI Mutual Fund. Uh, let's begin quickly with what are the key factors which are driving our markets. I think clearly global inflation has remained elevated compared to the historical levels, and this has largely been driven by both commodity prices as well as tight labor markets. Uh, a sort of a shift from where we were last month clearly has been in terms of global growth outlook. This has been revised lower and it still poses downside risks, particularly because of the tighter monetary policy actions, and also financial conditions have been much tighter than where they were over the previous months. For India in particular, the economic activity has remained resilient. We've not seen any major revisions as far as our current financial year's GDP growth outlook is concerned. And this has been on the back of fairly robust domestic demand and a fair amount of opening of contact intensive sectors, particularly in the services side. In India, the policy action in the near term is clearly being driven by both global rates as well as currency outlook. There is an expectation of moderation as far as domestic inflation momentum is concerned. We've already seen two consecutive inflation prints being lower than the peak that we saw for the month of August. Combined with that, clearly, we think slower pace of disinflation and some degree of inadvertent policy accidents could be key tail risks for the market stress. And this is something which I suppose market participants will be watchful for. Moving on to the global trends, clearly there has been a fair amount of policy tightening by all the major economies. But for the month of November, there were no key events. None of the central banks had actually any scheduled meeting, and hence there were no changes as far as the policy rates are concerned. In terms of the inflation trajectory, as you would note in the bottom right chart, it's been a mixed bag, but the trend for the US as well as for India has been one where we've seen month on month decline as far as our headline CPI is concerned. This also means that the overall trend as far as the global benchmark yields are concerned has been downwards. We've seen a monthly decline as far as the benchmark yields are concerned. This is broadly across the world, barring one or two economies. And this has been on the backdrop of better inflation data, particularly in the US, which has improved sentiments globally. As you look at this chart, this clearly does indicate that the broader trend as far as both commodities and also for food, two critical components for India's inflation trajectory as well, has been downward sloping. While for the month of November, there's been a marginal increase as far as the Bloomberg Commodity Index is concerned. This is again on the backdrop of some of the commodities which have seen a month-on-month increase, particularly when it comes to some of the metals. But thankfully, when it comes to one of the key commodity which influences India's inflation trajectory as well as the broader fixed income market outlook, and that is crude oil, has remained benign, declining by about 10% for the month of November. Moving on to the currency, India has actually been pretty much in the middle of the pack when you look at a longer term trend is concerned, which is the blue bar that you would see in this chart. We've declined by about 8% in the current calendar year, and more or less, places us in the middle of this entire emerging market and Asian economies. However, for the month of November, which is represented by the orange bars at the top of this x-axis, indicates that there has been a broad trend towards currency appreciation across, a larger spectrum of economies, and this has been broadly on the backdrop of, dollar weakening. We've seen the DXY index actually peak sometime in October and then decline for the month of November, which has also helped some degree of rupee appreciation. Coming to India in particular, one of the key variables that everyone tracks very actively is obviously the inflation trajectory. And so far, the recent inflation prints have not disappointed in terms of the broad guidance as indicated by RBI. We've actually seen the print for October, which was released in November, being about 60 odd basis point lower. So at 6.77, that is the latest print. We will soon see inflation prints coming in for the month of November as well. And that broadly does indicate a downward trajectory, which is a big positive. The blue bars that you see on the left hand side of this chart indicates what is the longer term trajectory as far as headline inflation is concerned. And again, as you would note, it does continue to decline progressively down to 5% in Q1 of FY24 before marginally moving up. So broadly, we could see sub 6% headline CPI into the next financial year. And this is also more or less supported by the sharp disinflation we've seen as far as WPI is concerned. The latest WPI print for the month of October, which was released in November, was at 8.39 and a marked, deceleration over the peak of 14-15% that we had seen during the months of May, June, and July. Looking at the other macro parameters, particularly when it comes to fiscal deficit and current account deficit, no material change over what we had discussed last month. But there are still some concerns that given the higher level of trade deficits that we are running, we could actually end up with a current account deficit upwards of 3%. The range as far as the markets are talking about is between 2.5 to 3.5%. And that's what is really penciled in as far as current financial year is concerned. Again, a good part of this current account deficit is, like I mentioned, driven by the widening trade deficit. We are seeing a fairly strong economic growth relative to rest of the world, and which has also propelled a fairly high level of imports. And within this, a significant part of our imports are driven by oil. Thankfully, we will see some improvement over there since oil prices have declined and hopefully should try and address some of the trade deficit gaps that we are seeing presently. In terms of liquidity in our markets, clearly we've seen a downward trajectory as far as system liquidity is concerned. This is measured in terms of the LAF numbers. And what you would note is that it has sort of more or less come to near neutral territory for the month of November. It's kind of increased marginally as we ended the month, but the trajectory clearly has been towards neutral liquidity, which means not a significant surplus or deficit. And this is also more or less in consonance with RBI's own strategy as far as liquidity is concerned. A good part of liquidity turning neutral is also being driven by FX intervention by RBI during the previous few months, as well as increase in currency in circulation. Coming to the bond markets, if you look at the sovereign curve, there has been a marginal decline as far as the yield curve is concerned. This is on the backdrop of a rally across the curve. The average yield decline has been between 5 to 10 basis point over the previous month. And again, like I mentioned, this has been largely aided by a favorable CPI print. Even if you look at across different maturity buckets as well as different rating profiles, you would note that for the month of November, yields have broadly, remained flat or declined marginally. Particularly when you look at, the 10-year yields across different segments, you would also note that the spread or between what a AAA bond trades at versus, the sovereign bond, the spread continues to be fairly narrow and tight. However, there's not been a sort of a significant decline as far as the AA rated issuers are concerned. And over here, there is still a reasonably good spread that's available over the sovereign bonds for the same maturity. Some interesting slides over, where we look at the real policy rates. This is essentially the repo rate less the headline CPI inflation. And having been significantly negative through most of 2020, 21, and 22, thanks to the rate hikes undertaken by RBI, the negative real rate now is definitely narrowing down. And at the present juncture, with the inflation guidance given by RBI and where we are presently in terms of the repo rate, clearly this number could turn positive. So the bottom part of this chart, where it's largely red, you could actually see it turning green, based on the current RBI projections. So that, I think, will be a significant shift from where we've been over the last 3 years. This is also in a way reflected by the markets when you look at the term premium spreads, which is nothing but the 10-year yield, which is the white line at the top end of this chart, less the orange line, which is the repo rate. You would note that the spread was at its widest sometime in the middle of 2022, which was almost 300 basis point. And since then, it's actually been gradually declining as RBI undertook rate hikes. So this sort of does indicate that the markets are more or less fairly comfortable with the current pace and terminal repo rate and have not seen any reason to widen the term premium spread. Finally, if you look at the volatility in the domestic sovereign bond market, we've seen some degree of narrowing down. Clearly, the period between June to September, you would notice pretty large spikes on either side of this orange line, indicating a very sharp or high level of volatility in terms of the 10-year benchmark yields. This is narrowing down, and I think as markets start pricing in a terminal repo rate and start factoring in no further rate hikes from RBI, you could see this volatility actually decline to what you would see in the earlier period of 2021. That would be a good positive for Indian bond markets. Again, markets expectations of nearing sort of the interest rate cycle is also represented here in terms of the spread between the 10-year yield and the 1-month swap. We seem to be sort of more or less now coming down to the average spreads of maybe just about 80 to 100 odd basis point compared to the 337, which we had earlier. So this is the final sort of chart that I have in terms of markets, and what you would note over here, and this is very interesting. This actually plots annual change in the 10-year yields for last almost 15 odd years. And what is notable here is that we've never had continued increases as far as 10-year benchmark yields are concerned. So we've always had phases where over a period of 3 to 5 years, after a few years of increase in the benchmark yields, we've seen periods where it has also declined very sharply. So this, I think, is an important sort of a signal for investors in markets that having seen 2 consecutive years of increases as far as the 10-year benchmark yields are concerned, which is 71 and 32 basis point for FY22 and FY23 year to date. It's likely that mean reversion could be, a likely trend going forward. So that will be something interesting to watch out for. So with these few charts, let's quickly look at one of the key events which actually took place in the month of December, early, last week. And this was one of the most watched monetary policy for FY23. And for the first time, while we did see a consensus-driven 35 basis point rate hike, but there was dissent within the MPC, with one member voting against any rate hike. Of course, in terms of the broader stance, the MPC continued with withdrawal of accommodation and also stated that further calibrated monetary policy action is warranted, which in a way does indicate that they would not be averse to another rate hike going forward. However, they did note a fair amount of caution as far as inflation is concerned. Clearly, there are still some degree of inflationary pressures, particularly when it comes to core inflation. And we also saw inclusion of core inflation as part of the monetary policy statement, this time round, not just the headline inflation. Finally, in terms of some of the data prints, I think not too much of a change. RBI did retain its CPI inflation projection at 6.7%. Given, I guess, the last 2 prints, both for November and October, looks like maybe, this number could be exposed to some downside risk if the current momentum and trajectory prevails. While on the growth front, RBI did tweak its growth outlook marginally. They brought it down by 20 basis points from 7% to 6.8%. Finally, on the liquidity, RBI was quite comfortable with the current state of liquidity in the system. They did mention that it remains in surplus, and with average daily LAF of about 1.4 trillion rupees, it also would ensure that it remains fairly flexible and would indulge in two-sidedness as far as liquidity operations is concerned, which means that they will not be afraid to intervene if liquidity was to tighten by indulging in some degree of variable rate repos so as to infuse liquidity to the system. So, in terms of the guidance, I think RBI was very clear in stating that they expect liquidity to improve in the next quarter, but largely because of the surge of currency in circulation that we had seen during the festive season, reversing somewhat. Government balances being drawn down as government undertakes expenditure program, and also we've seen some degree of increase in liquidity driven by RBI's own FX actions, where they've actually been selling dollars. So, what are the key takeaways for the fixed income markets? Uh, Clearly, in terms of inflationary trends, largely declining, and we are seeing a very similar trend both for the advanced economies as well as India. We do expect some more tightening both by the Fed, ECB, and the Bank of England. In fact, this week is very busy, and there is expectation of rate hikes from all the three central banks. For India, we continue to expect a terminal repo rate of 6.5, which effectively indicates that you could see a potential rate hike, over the next policy meeting. We think 6.5 provides a reasonable spread, both to address the volatility, both in terms of the variability of our CPI trajectory, as well as also provides a real rate of return for domestic investors. This we think will help stabilize INR and also uh, invite additional portfolio flows into the fixed income markets. But if you look at the terminal repo rate versus where we are today after the recent rate hike, clearly we seem to be nearing the end of this tightening cycle. In this monetary policy cycle, I think RBI has been fairly consistent in addressing inflation over growth, and both their action and stance has clearly been articulating that quite actively. This has also meant that we've seen a fair amount of repricing of the curve, and one of the reasons why in the earlier charts you would have noticed that the term premium spread has actually narrowed down in spite of RBI continuing to hike rates at every policy meeting. In terms of the current valuations for the money market curve, we're not expecting any material disruption. Clearly, the curve is extremely flat. However, there could be a bit of volatility driven by the usual quarter end and financial year end demand supply of securities. So, in terms of what can the investors do, again, we have two recommendations, and we've been fairly consistent across previous months. Since there's been a significant correction in the short end of the yield curve, we believe that investors with up to 12 months of investment horizon should look at products in the low duration money market categories. We think these are the two fund strategies which will sort of help you attract a reasonable rate of return without any additional volatility. And at the same time, with the fair amount of repricing that's taken place at the short end, it does offer you, from a 1 year perspective basis, a real rate of return as well. For investors who have an investment horizon of above 2 years, can actually look at actively managed short-term strategies like the short-term income fund and corporate bond strategies. There is an expectation that with the cycle having peaked, the next move, as is true for global central banks, would be one of easing. And this is clearly articulated if you look at the Fed futures, which is really pricing in rate cuts in 2023. With that sort of a backdrop, clearly, actively managed short to long duration strategies could be looked at by investors. But the way to approach slightly longer term funds, especially with investors who have investment horizon of more than 3 years, would be to stagger their allocation because, as we have seen over the recent month, the yields have more or less moved in a narrow band, but have broadly been in a sideways movement. So that, along with maybe a roll down strategy, would be somewhat interesting product allocation. So we would advise investors to look at both at the short end in the low duration money market funds and in the 2 to 3 year and 3 year plus kind of investment horizons. Look at short term income funds, corporate bond funds, as well as some of the roll down and dynamic bond fund categories. So this is where we are in terms of our overall takeaways for the month of November. And with this, happy to take questions.
Well, thank you, Amandeep, for sharing the insights. It was quite useful, and I would request viewers to keep posting their questions on the link provided to you. In the meanwhile, I'll take up the questions which are already queued up. Okay. So the first question is, do you see rate cuts happening in the second half of FY24, considering RBI
So I think at the present juncture, view is
is
that
focusing growth? So we have been placed well in the global economy so far. But looking at the geopolitical scenario, we can't neglect the fact that India will not be isolated. So what are your views on this?
so in terms of expectation of rate cuts early in 2023 from RBI, I think we are of the view that RBI will be extremely data dependent and will watch global developments for the broader monetary policy actions, particularly of the US Federal Reserve, and then react accordingly. So at the present juncture, I think one can safely say that RBI would prefer to hold on to whatever terminal repo rate they've been targeting for some period of time. Watch progress in terms of the inflation trajectory actually playing out to what they have forecast for FY24. As you recall, in the on the 7th December, in its December policy meeting, they did give a guidance in terms of the inflation outlook, and I think they'll be clearly watchful for that. On the global front, you're right. We can't remain immune to what's happening with rest of the uh, you know rest of the world in terms of both monetary policy actions as well as the broader economic growth. I think over there we are in a much favorable position. As you're aware, the inflation drivers are very different for its advanced economies versus India. I think in India, we are really are seeing benefits of a declining trajectory, whereas in the West, you are seeing a mixed bag where it is declining somewhat, but it is nowhere near close to what the central banks are targeting. So there is still a very large delta or difference between the likely trajectory for, say, headline inflation in the US or for that matter, European region versus what the central banks are targeting. So to give you a perspective, the inflation over there, the latest print was 7.1 versus the 2% that they're targeting. And it's like, over 10% in the UK versus again 2.5% that they're targeting. Whereas for India, we are already seeing sub 6% inflation numbers. And, the target clearly is the middle pack of 4 to 6, which is around 5% in our view. So we're very close to that.
Okay. Sure. Thanks for the answer. So, on a follow-up question, since the inflation numbers recently have come down in the RBI's no target band of 2 to 6%, it is now below 6%. So, do you think the RBI is going to pause from here or on the policy cuts, or what is your view on this?
So I think, like I mentioned, you're right. Inflation has clearly surprised on the downside in the latest print. But the key driver for that was largely a very high degree of disinflation as far as vegetable prices are concerned. So, vegetable prices came down year on year by almost over 8%. And given the weightage in the index, that element alone led to a decline in headline inflation by over 60 basis points. So I think some of these are very high frequency, very volatile, data points. And one can't take, a single data point as being a driver of a trend. So we will be watchful for that. But like I mentioned earlier, the broad trajectory still remains one where it sort of trends closer to 5.5%. And that I think will give some comfort to RBI. But are we expecting a pause as soon as now? I think, like we mentioned in our outlook, we do expect the terminal repo rate to be at 6.5. I think it's just a debatable point whether 6 quarter is adequate or 6.5 is adequate. But I think we do need to build an adequate margin of safety or buffers for the kind of volatility that we see in our, in our CPI index, and also to try and ensure that we do build in some margin of safety if, let's assume, our the US Fed continues to keep its rates at much higher levels for much longer.
Thank you, Amandeep. So next question is from our viewer, Hemant Ashar. He is asking, the FD interest rates will rise a little further from here on. So what are your views on this?
So, given the strong credit growth that we've been witnessing, in the second half of this financial year, clearly it does indicate that there is requirement for banks to increase the deposit rates and mobilize more sources of funds through deposits. But what we've also witnessed is that it's not been a very broad-based increase in deposit rates. So at the present juncture, in my view, if you really are looking at a 3-year or a 3-year plus sort of a investment horizon, uh, the mutual fund products can still outperform, both in terms of the carry right now, as you're aware that the YTMs of some of the funds, uh, which are sort of very evident in the fact sheet that will be available to you. Plus, if you're looking at a rate cycle playing out over the next 3 years, which is in terms of the rates peaking and then the sort of additional upside you get through capital gains when the rate cut cycle starts, and there will be a rate cut cycle because clearly all the central banks will start cutting rates the moment they start seeing a sharp decline in their economic growth and also start seeing decline as far as inflation trajectory is concerned. Then I think you are able to capture that much better through a mutual fund product rather than through a fixed deposit.
Sure. So a question here is, since the credit growth has started to revive, so what actually is driving the pickup in the credit growth?
Yeah. So it's a combination of factors. Clearly a large part of the credit growth is being driven by increase in retail, credit, which is essentially a function of consumption demand, which is a function of, demand by the housing sector. Again, consumer durables, automobiles, such likes, all these household driven demand is actually helping credit growth. And we're also seeing some degree of, replacement demand coming in from what the corporates used to borrow offshore in the foreign currency through ECB route coming onshore. And then, of course, we've not yet seen a significant private capex, which clearly is a much more stronger driver of longer term credit growth. But there is some degree of brownfield expansions, or at least some degree of capacity enhancements, which some of the corporate sectors are undertaking. Because clearly growth has been fairly good for the current financial year, and even the outlook for the next financial year, which ranges between 5.8 to 6%, indicates that India will be one of the fastest growing economies even into the next financial year. So I think some of these are clearly driving up demand for credit, both from an investment perspective as well as from consumption, oriented segments.
Sure. So on a follow-up question on this, so do you think this credit growth is going to sustain from here on?
So, clearly we have seen mid-teens kind of credit growth, which to some extent may not be sustainable beyond a point in time because, some of this credit growth is also fueling consumption and hence driving up inflation, which is very well reflected as far as core inflation is concerned. I think there is a sort of a broader consensus that the tighter financial conditions, which are now being imposed by central banks across the world, will lead to some degree of slowdown. Some of the economies are even talking of a small recession. But I think for the global growth per se, there is clearly some downside risks. And the moment that sort of starts taking place, even in India, we will see some growth slowdown. In fact, like I mentioned earlier, for the current financial year, we are looking at 6.8 GDP growth. But for the next financial year, the growth is sort of ranged between as low as 5.1 to a high of 6%. So that sort of does indicate that there is definitely some degree of slowdown as far as economic growth is concerned. So clearly, as we go into the next financial year, it's unlikely that credit growth could sort of sustain at these high levels.
Very well said. So next question here is, According to you, what pockets of the bond are in the current scenario?
Sorry, Sonal, I missed that question. The sound dropped
Okay,
in
I repeat
between.
that again. According to you, what pockets of the bond market are attractive right now? Which funds are best suited in the current market scenario?
Right. So I think I would again reiterate, the recommendation which I ended the presentation with. You clearly need to look at what your investment horizon is, and then look at an appropriate product to match that. So if you have sort of a conservative, investment or risk appetite, then one would recommend, either roll down strategies, which are passive funds and do give you, much less volatility in terms of your, holding period, or alternately look at targeted index funds. Again, these also sort of do provide you with lower volatility, but a very defined maturity and, and some sort of predictability of the returns. However, if you're, looking at investments beyond 3 years, and like I mentioned, you could actually be taking benefit of the interest rate cycle playing out, which means interest rates peaking and then declining afterwards. Then maybe some of the more active oriented strategies, particularly funds which can actually run durations of up to 3 years and beyond 3 years, could be suitable. So funds that would be appropriate at that juncture would be products like UTI short-term income fund, UTI corporate bond fund, or UTI dynamic bond fund. So these are the funds which I would suggest could be looked at, and do allocate your money in small proportions into these funds, but also do be cognizant of the fact that your investment horizon should not be just 6 months or 12 months, because, like I said, the big gains will take place only once uh, the central bank starts cutting rates, which can be adequately captured through longer duration funds.
Sure. So, what do you advise to investors already invested into roll down kind of structures in fixed income funds or target maturity funds who entered these funds in FY22?
So I think given the volatility in the early parts of FY22, if you have already allocated and invested money, since you would have come into these funds with a very clear objective of holding on till the maturity of the roll down strategy or the maturity of the index fund, clearly do hold on to those investments, because otherwise you would be possibly booking losses if you were to exit today. What I would advise you is that for the incremental money that you allocate towards fixed income, this is a good point in time, given the risk reward ratio and given some of the charts which I've shown to you, also clearly indicating that, we seem to be near the fag end of our rate hiking cycle. And hence, you're not looking at the same degree of volatility as far as, bond yields are concerned, whether it's a sovereign or the corporate, like we've seen during the first 6 months of this calendar year. So I think from that perspective, do allocate money into the kind of funds that I just mentioned to you.
Thanks, Amandeep. So next question is from our viewer Vikas Mehta. He's asking, are credit risk funds risky? Do you see more volatility in these kind of funds? And if Fed continues to increase interest rates, how will this category move, and what are the other options for investments for the investors?
So I think if you look at, one of the charts which I had shown in terms of how the yields have behaved both for AAA and AA, you would find that, the sort of the AA segment, which is where a large part of, allocation for credit risk funds would lie, are, sort of above 8%. But again, the spreads are much tighter than where, one would have seen it as per the sort of historical trends. This is primarily again a driver of, two things. One, the credit profile is far better, and one isn't looking at any degree of credit stress or, risk as far as some of the well-known double A rated issuers are there. In the single A space, again, we've actually seen both nominal as well as, spreads narrow down far lower than where historically they've traded. So I think from that perspective, at the present juncture, possibly I would recommend that let the interest rate cycle play out. You can better capture it through a more liquid and high investment grade portfolios. And hence, we are recommending corporate bond fund, banking PSU debt fund. We are recommending short term income fund. Those I think are appropriate products at the present juncture.
Sure. So our viewers would like to understand a broader positioning of UTI fixed income funds in terms of adding duration to UTI debt funds.
So I think if you look across the funds, clearly, we have been actively changing duration, while it may not be fully reflected in the month-end data that you see in terms of the portfolios, because a lot of the movements that have taken place have happened during the month. But we do have funds where each fund manager exercises his view in terms of where he would like to add duration. So in some of our funds, like the short-term income or dynamic bond fund, you would have noticed that the funds are sitting on relatively low duration when you look at the month-end data points. Whereas on funds like corporate bond fund, banking PSU, or even the UTI bond fund, you're actually more or less close to the median in terms of the duration that we're running in those portfolios. And that again is a reflection of the kind of strategies individual fund managers follow. We do not have one sort of one view which is sort of replicated across all funds. I think every fund manager looks at timing, the changes in the duration as he would seem fit. Now, you must also understand that some of the fund managers clearly have a lot more degree of flexibility to suddenly add duration or reduce duration, because being in the markets during the day allows them a much higher degree of awareness or knowledge, take those views and implement it very quickly into their funds. But on the same time, when we have active managed funds, we also have, other funds like, the UTI 10-year constant maturity GSEC fund, where, it's a passive strategy. If you do not wish to be sort of influenced by views of the individual fund manager or the strategy that the fund manager is following, then that's a product which you can look at in terms of, your own timing of entry or exit from the sort of the period of the interest rate cycle you are at.
Thanks for the answer. So our next question is from a viewer, Mr. Ramesh Chandra Nandrajov. He's asking, what is the probability of recession gripping USA and what would be its consequences? Consequences.
So I think if you look at some of the indicators, particularly, the most commonly followed indicator is the shape of the yield curve in the US, and that is inverted, which means that the long-term rates are much lower than the short-term rates. And that has been indicating a recession in the US for almost, I believe, 4 odd months. It has only steepened further, which means it's now indicating even a much stronger recession than what it was projecting maybe 3 months ago. And this has broadly been a good indicator in the past, but like I said, it's sufficient but not enough to indicate a recession in the US. I think there are a lot of other economic factors which the Fed is also watching out for, so which at the present juncture are not indicating any signs of recession. But if there were to be a recession in the US, clearly, you could see a very sharp reversal in terms of the interest rate cycle. I think a recession in the US will percolate across the world. And that, I think, to some extent, will also then influence the policy actions from the central banks across the world. It could be, in Europe, it could be in India, it could be in Indonesia, it could be in other parts of Asia as well. At the present juncture, if you look at the current set of economist forecasts, I think most of them are at best looking at a small marginal recession, which could be translated into 1 or 2 quarters of negative GDP growth rate, but not a sustained or a continuing recession in the US.
Sure. Thanks for the answer. Our next question is, what is your expectation on the government borrowings for next year, and how does this will impact markets?
So at the present juncture, we are not expecting any negative surprises from government borrowing in the next financial year. I think two things clearly have been supportive. One, growth has returned, and we are seeing nominal GDP growth rates upwards of 15% in the current year and maybe 11 to 12% in the next financial year, which will be quite positive as far as revenue collections are concerned. We've also seen a much stronger tax buoyancy in the current financial year, as is evident from one of the key data points that everybody tracks, which is the GST collections on a month-to-month basis. So this does indicate a much better revenue trajectory than what we had penciled in the budget estimates. So I think given this and the lack of any significant requirement for the government to undertake, subsidies or any other form of such social expenditure in the next financial year, we think broadly one could look at, the government borrowing being somewhat flat to marginally lower, which would indicate that you could actually see a fiscal deficit number which should be lower than where we are for the current financial year.
Sure. So our next question is, a recent SEBI circular, capped investments in mutual funds, in single issuer according to the credit ratings. So what are your views on this?
Yeah. So I think this is more or less a continuation of some of the changes which the regulator has brought about in terms of the PRC matrix and calculating various credit risk parameters for a fund. I think it's a good move because it sort of does indicate that the 10% limit for an issuer is not an omnibus approval, irrespective of the rating profile of the issuer. So this is a graded way of limiting exposure to lower rated issuers. This is something which I don't know, which I hope you are aware is being actively followed in UTI within our GIMS framework. So our GIMS framework, which stands for GATE, Investments and Monitoring and Surveillance, is an investment framework where we already build in a very clear matrix for each fund, both at at an issuer level, at an aggregate rating level, and that more or less is pretty much aligned with what SEBI has mandated for mutual fund industry. So from UTI's perspective, I think we have already are well ahead of compliance, and we've been following much tighter limits for single issuer limits within our funds.
Sure. So, moving on to these questions, I know it is little repetitive, but viewers are still asking these questions quite often. Amid the interest rate peaking, what an investors with a longer duration should do? Should they, invest in a lump sum mode or a staggered approach should be followed? And so, if you can just reiterate this.
So I think that is a good suggestion. I think we've been also talking about it. If you've seen the presentation again, we talked about staggering your investments in either roll down or in actively managed funds. And this is because while we may believe that the interest rate cycle seems to be peaking, but it could still be exposed to some degree of volatility. So rather than timing your investment, at a particular sort of benchmark yield levels, it's better to sort of stagger it over a period of time, such that your point of entry is indifferent to the market levels. So if you are looking at investment horizon, like again I repeat, of 3 years and beyond, within which it's quite likely that you could see the reversal of the current interest rate cycle, then I suppose allocating or staggering your money over a period of time into long duration funds would be a good strategy to follow. So to put it differently, if you were to do an SIP, a monthly SIP over the next 6 months, well, into say March, would be a good strategy to follow in the current environment.
Sure. So our viewer, Ms. Shweta, is asking, is ultra short bond fund category is good in current scenario, and should it be looked into, for next 6 to 12 months?
So, this is something which we've been often repeating. In our view, all product categories are good and suitable for a specific, investment horizon and a specific risk appetite. And this is something, which we often articulate through our presentations. And you would note that for every fund, there is a suitability of, investment horizon that we suggest. And there is also a certain riskometer driven risk profile that we, articulate for each of the funds. And I think you have to look at these parameters before choosing between, let's say, an ultra short term fund or a low duration fund. So ultra short term fund is clearly for investors who have an investment horizon of 3 to 6 months. And we've often advised that you must match your investment horizon with the duration that the fund operates within. That sort of, in a way, ensures that you do not face any unexpected volatility, and your return expectations are aligned with kind of, sort of performance that the fund can deliver to you. So if you do have an investment horizon of up to 6 months, then an ultra short term fund would be suitable. But if you have an investment horizon which extends 6 months and could go up to 12 months, then we've always been suggesting, UTI Treasury Advantage Fund. So, over to you.
Thanks for the question. So do you see, hello, can you hear me?
Yeah, Sunil, I can hear you now.
Okay. So one last question for today. We have already taken up a lot of questions already. So do you see a critical role of target maturity bond funds in the investor's portfolio?
Yes. Again, it's again a function of an investor's investment horizon and the risk appetite. If there are investors who have extremely low degree of risk to handle volatility and would want to have some sort of predictability in the return profile, then a target date fund is much more suitable, because you know right in the initial stage what kind of a duration you are running in that fund, you know what kind of a portfolio you are investing in, and what will be the final maturity of the underlying portfolio. And hence, you know that end of that maturity, I will get my money, and this is generally what, the typical securities in the funds, in the fund's portfolio can deliver. So I think that combination is suitable for investors who have extremely low tolerance for volatility and, the kind of swings which an actively managed fund can have. However, like I mentioned, if you are somebody who has a relatively higher risk appetite, can withstand the volatility, and with higher risk comes higher returns, and then I guess you can possibly look at the actively managed medium to longer duration funds, which can actually take on higher risk because they will obviously be taking duration which would be higher than a target date maturity fund. And they also have a lot more flexibility of switching between corporate bonds, G-SECs, G-SECs, SDLs at different phases of the cycle. And in the end can have the potential to deliver, right, relatively high returns. So historically, if you've seen, actively managed funds do outperform passive strategies or even, other passive investment options like term deposits.
Thanks, Amandeep, for the answers. I would request viewers to please share your feedback on the link provided to you on your screen. And so would you like to share any closing comments?
Thank you, Sonal. I guess I would want to thank the audience for being patiently, attending this call here. I hope you found this useful. We will continue with this on a monthly basis, and you'll get a chance to hear from me and my colleagues during these monthly calls. Not just a market update, but hopefully try and address the concerns and questions that you may have. So please do join us every month and look forward to active participation. And do also give us your feedback so that we can improve, uh, our monthly market insight program. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.